Okay, folks, welcome back. Today's Tuesday, October 11th, 2016. Okay, I gave you a couple things to study this morning on the dollar CAD via Twitter. So you'll have to go through the Twitter feed to get these charts that I'm going to refer to in reference. I'm going to zoom in. Okay, and this is kind of what ends up happening a lot. I'm going to take this line off here because this is not what I initially showed you. The folks that do have the benefit of being able to be in front of the charts all day long invariably will have a tendency to want to zoom in real tight. And if you look at the charts I shared this morning, we had one of our members share a successful trade based on a bullish order block and going into London. We traded back into the bullish order block, the down candle, right for the move up, and it showed him a profit. And he gave feedback to the community that it was a relatively easy trade for him. Now, I don't know if the context was framed in what I'm going to show here, but what makes it easy and what made it easy is what we're going to highlight. And then we're also going to highlight what makes certain order blocks a little bit more challenging or require a lot more in terms of response, or they will be violated. Now, if we look at price as I was outlining this morning, I gave you a couple different examples of how each down candle was being supported by new buying. This down candle here, price trades back down into it here, and price rallies away. Price trades down here into the series of two consecutive down candles. This is the equivalent of a 30-minute bullish order block. Okay, smart money buys as the market goes down. Two consecutive candles, it trades right into that here, and it rallies again. Price comes back down again, trades into this down candle. Is there new buying? Yes, new buying occurs. And it takes out this old high. Now, what's important is I was showing you a zoomed in perspective like this, not giving you the entire scope of what you should be looking for as a trader. When you're taking trades, you need to be looking at the entire landscape. Don't just focus on these smaller time frames, because if you do, you're going to miss all of the most important, significant price levels. If we notice by zooming out, I highlighted this in a chart on Twitter as a liquidity void. Now, the gentleman that shared on the Twitter today that he had a long off the order block here, and it rallied up rather handsomely for him, and in his words, it was an easy trade. What made it easy was the fact that we were trading off of a bullish order block, but all of this range in here was only traded on what side? The sell side. It was only going down. There was no up movement through it. So it was all, think about that paintbrush analogy I use. The paint was applied to the canvas only on the downstroke. There's been no up movement to fill in this area here, which the three up candles start. Once it breaks below the body of that up candle here, that's when the void begins. Okay? There's a fair value gap between the low of this up candle and its body. It fills in initially here when it runs up. Then it retraces one more time into a bullish order block, and then it runs through it one more time, trading up into these three candles, which would be what? If we could make a 45-minute chart, this would be a 45-minute bearish order block, because it's three consecutive 15-minute candles. This highs ran out as it closes in the void. Now, the question is this: if we watch price come back down and we look at this down candle here, should we expect to see price see a strong response off that level, having all this understood. It can happen, but we don't trade in it can happen. We trade in high probability or low probability, and we focus primarily on trading in conditions that are high probability. So if the market had all this range to close in, and it did so rather efficiently this morning going into London and then stabbing up into pre-New York, if we see this occurring and we see the market come back down one more time to a potential bullish order block, the probabilities are, especially if we're one-sided, okay, the probabilities are not as strong as if we were trading in the condition that we saw going into London, because all of the void was all exposed here. It's all open range. So it allows price to want to run up there aggressively and have no real resistance. So in essence, what was the London open setup by definition? Would it be a low resistance or a high resistance liquidity run? Obviously a low resistance liquidity run, because price is only traded down in this range. So all the price action between the opening of this candle, essentially 132.32, all the way down into, we'll use the opening on that, 131.79. So between the opening of this down candle right here and the opening of this up candle right here, all between those two price points, and I'll shade that in for you. All of this is a liquidity void. That means it's only been offered on the sell side. It's all been one-sided. It's been big candles, no real back and forth type of action. So as price, let's do it like this, you can see it in context. Price starts to trade higher. Now we're into the void right there. So as price is rallying up, it's going to want to fill in all of this. That's how you use a liquidity void. Price comes back down. Now we have midnight in New York. Price has a small little Judas swing there. Right back into bullish order block. Bullish order block forms again. We have an impulse swing. Retraces back into another bullish order block. There's your buy. Now if you're buying there, you have relative equal highs in here. Also, you have all these prices up here. So now the void really is here. So you have this exposed area to trade up into. If you get a buy here, you want to see it trade up into that level here, because this is all one-sided down price action. You want to see it trade back up into it. Price expands. Boom. It closes it in right there. Okay. Then you get a little retracement. One more time it pops through. Runs out that high right there. So now we're looking at this, and we offered this as a study this morning. Should this be a buying opportunity up against a void? It can. That's the thing. It can happen. But the probability shift to a lower probability because there's not been any runs on stops. We've already seen the market run up there and close in this gap. Okay. All that void is filled in. There's nothing in here near term, okay, that would be a resistance for price to come back down and take stops. See, everything's been one-sided today. Here's the low. We have a higher low, higher low, higher low. We broke new highs each time, but this high, breaking this high here, it occurred as we completed this void. So, and we're trading inside the range, okay, or trading fair value, because the long in here, the young man shared on Twitter today, he should have been aiming for fair value, which would have been closing of this gap, or the fair value gap between this low up to this opening price. And we're going to give a lot of specifics about that, but I want to give you examples of it repeating over and over and over again, and why it gives us really easy, low resistance setups, where that's exactly where you want to trade at. You want to trade in those conditions because it gives you a lot of peace of mind, and it also gives you context, which is what a lot of us as new traders do not have many times. So I highlighted the fact that if we see a bullish order block, but we closed in a void on the upside and it's been bullish, time of day, okay, we're going into the New York setup or session. So we could see a retracement all the way down into the sell stops. Now the sell stops reside below this swing low here. Then we had sell stops below here. And then if we really washed out, it would have been a run on these equal lows over here. Okay. Now I highlighted in the most recent chart the opening price off that midnight candle, which is very, very influential. Okay, the opening price comes in at 131.98, 131.98. So all below here, the young man that shared his long on $CAD this morning, he was actually buying below the opening price, which is, if you're going to be bullish, that's the best time to be entering. So here we have another area of sell stops right below that low. Now think. Price has been going higher, 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 higher. Hits the liquidity void, runs the high here. If it trades back down, is it good? Is it good? And would it be good for it to want to retrace back down into after taking out a high, after closing in a void? Would that be essentially a strong or high probability setup? In my opinion, no, because we've already closed in its low end objective with the least amount of resistance. So it's already closed in that. And we've also pierced a high. So if it's strong, if it wants to go higher, it will continuously expand up. But if it doesn't show signs of doing that and it does this, even though there's an order block here, I'm going to suspect that it's going to go for the stops because we've already closed in a significant institutional order flow reference point by way of the liquidity void over here. So when you're looking at your setups and you're looking for trades, your eyes are looking for these voids. You're looking for these real easy paths of least resistance where price can easily trade up through it. And especially in this case, it's been a down move here. So it creates the void on the downside. So if you're long, it makes it easy for price to trade up in because there's really nothing over here to offer resistance. Think in terms of classical support resistance. If you're buying here, outside this short-term high here, there's nothing in way of staving off up higher prices except for the return back to this 3 up candles, which would be a bearish order block. So it allows us framework and gives us context to look for setups. Now, if you see these things happen, even though it's time of day and it's New York setup and it's been going up, the idea of how do you know when it's going to run for the stops and when to look for an order block, this is one of those examples. It gives you a real experience to relate to, so you can say, okay, look, next time I see a liquidity void and I've been buying and maybe it's been fruitful, if I see an order block form just below, like we saw here, okay, if we see that, we don't want to look at that as a buying opportunity. This is not a high probability buy bullish order block, but a turtle soup run below these lows here or return back down into this order block, which would also be below the opening price. See, that's why it's important you have to be focusing on that opening price at midnight, New York. Because if the range is going to expand, let's take a look at the dollar. The dollar reached up finally into that 97.30 level we were looking for last week. We breached it, came back above it, almost went 20 pips. The high came in at 97.47, so I was 3 pips away from that, seeing that 20 pip grade sweep. It could expand up in here and do that, but price came down, hit this area in here, bullish order block. One more time, we've seen response. Because we're expecting modest bullishness on the dollar still, if it's going to be bullish, they're going to want to come back and take those stops because nothing over here, with the exception of this little blip taking out this short-term low here, there's been really no runs on sell stops below the marketplaces. It's just not on the 15-minute time frame at least. And price does what? It trades down, clears out the stops, trades into what? What is this here? Bullish order block. Why is this a bullish order block? Because it's the down move, down candle, right before price trades higher, and it takes out the short-term high. So this is a real high probability candle. And you also have what? Think precision trading concepts. We have a swing low So stops will be resting below that, and then we have an order block just below it. So if price can come down here and hit those stops and hit the order block, that's high probability. And that's why you're seeing the sensitivity of price action here. Okay. So what I want to share with you today is the importance of what I showed you in the first month, September. I told you what to focus on. If your eyes are focused and trained in on areas of where prices moved away quickly, in the example like we showed here, okay, these voids, if we can look for these levels in price and we get enough of a range, see, that's enough of a range in there to offer, well, let's see what it is in terms of pips. Okay, we identified the opening on this candle at 31, basically 31.80, and the opening on this candle here at 32.32. So roughly what, 20 pips? I'm sorry, 50 pips. So we have a range of about 50 pips. So if you can get a long in here, and if you're buying down here, you still have the potential to make as much as 30 pips. And that's good. I mean, that's all you really need. 40 pips is ideal. I look for swings that offer at least 40 pips because even if I get it wrong and factor the spread on both ends, getting in and getting out, it'll at least give me 20, 25 pips of potential range, and that's fine. That's the low end I want to do for my trades. But if we see scenarios where we can get long inside of the range, what is this range? The range is this high down to this low. So think about what's going on here. This is the range defined from the high down to the low, okay? If you're buying down here, you're buying below equilibrium, so you're buying at a discount, okay? And on a smaller impulsive price swing here, this movement back here relative to this low to this high, this is below equilibrium and it's in discount, and that would be a range expansion, and it would be justified to see that long. And it's additionally below the opening price of today, which is here, which is denoted by 131.98. Okay, so price had a lot in terms of offering upside potential, but as soon as we close in this void, if you're long, you got to really take a lot of the position off there, because one of two things can happen. One, well, I guess three things could happen. It could continuously go through, and you want to pay yourself, obviously. That's the best scenario. The other one is what we see here. It can go up and then stall and retrace. And if you've trailed your stop loss too tightly behind you underneath recent lows, this is what tends to happen. The price comes back and takes that position out. And you don't want to try to take your position off either by stop or by collapsing in partial profits on movement against you. Okay, if you can save your stop before it makes a run on it, that's ideal. But you always want to try to take the trade off in the best condition. That means moving away from your entry. So if you're short, you want to be trying to collapse your trade on a down candle or movement away from your entry. And if you're bullish, you want to be trying to collapse your trade and saving your stop on an up candle or movement away from it, or collapsing it with profit as it moves away from your entry. That's the goal. That's all part of trade management. You'll learn a lot of that as well. But in here, the idea of looking for setups, okay, let me ask you this in closing. If we are looking for liquidity voids like this, okay, this is your gold mine, okay? You're all like treasure hunters, okay? You get in the charts and you're looking for something. You've all been looking for some neon sign to flash across the screen. This is what you should be looking for. This is what the setup is. This is what tells you when to get in, when to get out. It tells you everything. It tells you everything you need to know when you find these areas in price action. These gaps, okay, they have a high probability of filling in. Now, the fact of when they're going to fill in is all relative to the price action at the time that you're studying it. That void could stay open for months. But as it were, you can see that the market opened today. It traded down initially, gave us a market protraction or Judas swing, rallies up, comes back down, gives us an opportunity to be a buyer, I didn't take this long. I did not take this, but I framed this whole teaching today on the gentleman that shared his long on Twitter. And I thought it was a really wonderful study because he asked about, would this candle be a propulsion candle relative to the down candle here, which is a bullish order block? And the answer to the question was obviously yes. And then you had propulsion candle here. You had order block. Each one of these are bullish order blocks, and you have a propulsion candle here as well. I don't want anyone thinking that a propulsion candle is anything different about a bullish order block or a bearish order block. In this case, it just gives us significance to expect a dynamic move away from it. It should be a high responsiveness away from that order block. The initial order block, we don't know if that down candle is going to present the impulse swing. That's the part we wait for high probability setups. Once it occurs and price clears the high of the down candle, then you just simply you just wait. You wait around. And you know exactly what to wait for. You want to see price come back down into the down candle. When that occurs, that's the buy. That's when you buy it. So if you're looking in this in the context I'm sharing here, if you were seeing this down candle, the price moves up, and like the young man did this morning, he went long here, he bought it, and if you see that, you got to look over here. You have all of this exposed range, okay, and where the liquidity void is formed. So if you're buying down here, let's say you're looking at the opening price on this candle. Hang on one second. So if you're looking for a move from the opening price on this candle, again being 31.86, so if you were going long with a limit at 31.90, from 31.90 up to 32.30, you have 40 pips offered to you in range by being a buyer here, and with the expectation of price is going to close in all of this exposed range. So that's the foundations to looking for the setups with trading inside the range. There's opportunities, obviously, when there's a break on previous highs and previous lows that are low resistance liquidity runs, but inside the range, this is how it's done. You'll see that you don't even need to get 40 pips up to that level here. It's very clean. It's very easy to determine what that range would be. Everything we've described in previous teachings gives you framework for the long in here, but it tells you where price should go. And why it should go there is because this market's only been delivered on the sell side here. So the market's going to want to do what? Think like that paintbrush, okay? You load the paint on the paintbrush and you put it to the canvas and you stroke down on the canvas and you apply the paint, okay? And then you start going up, okay? Well, you're going to have to get more paint. When you retrace, the paintbrush is going back in that bucket again, adding more paint to the bristles, goes up again, go back into the bucket, get some more paint, apply it to the canvas, come back to the bucket, grab more paint, apply it to the canvas. Now you've closed in all this little area. And if you've done any kind of painting of any kind, especially if you've done an interior bedroom or a living room or whatever, when I was younger, I did it. I don't do it so much now. I'm not that proficient without making a mess. But you know what it's like to put paint on a wall. You know, when you first put the paintbrush there, the first couple inches is beautiful. It's vibrant. It's ample amount of delivery of the paint. Well, price action is just like that. You know, over here we have an empty canvas. Here we have the paint being applied here, but it's creating little pockets that need to be filled in. You don't see it when you look at it just like this as a new trader, but because of your understanding of price action now and you're learning more about it, price is going to want to offer the buy side as well, going up. So both sides of the marketplace in an efficient price delivery, let's say it like this, every portion of every range, I don't care what range or time frame you look at, if price has been delivered, okay, and this is what I want you to come away with today, and we're going to close this session. If price This is, I'm telling you, what I'm about to tell you right now is 100% millionaire making. So pay attention. Turn the soap operas off. Turn the Cartoon Network off if you're home watching with the kids. If we see a range of price, and it does not matter what time frame, it does not matter. It's completely 100% universal. If we have a range, and it doesn't matter what the range is, but say we've defined the range where price has shown a really one-sided delivery of going lower. Okay, so we saw price trade lower, going down. Ideally, you're going to be looking for price. If it's down here, okay, prices drop down between the range of 132.09 to 131.54. Now I'm giving you this as an example. Okay, I'm not specifically aiming anything over here price-wise relative to this currency pair. I'm speaking in hypothetical terms. So if price is delivered, like we see it here, it's offered all on the sell side. That's what's being conceptually described here. Okay, all one-sided going down. When we see a reason to be a buyer, okay, what we're expecting is in an efficient market delivery of price, the range is going to expand up, may retrace back, expand back again, come back, expand again, come back, and then expand again and fill in that entire range that was offered on the sell side. The buy side will fill in. And reverse is said for when the market makes a move up initially. If the market move is seen as a sudden movement higher, okay, and we see a liquidity void with a price running up aggressively, eventually, some point, the market's going to want to efficiently trade all that range that was offered on the buy side only with sell side delivery. And then you'll have efficient price delivery between both those data points in terms of price. 32.09 and 31.54 will have been efficiently traded. When we see an absence of price being offered on the opposite side, in other words, if it's only been buying, okay, we're going to be looking to close in or trade inside the range down into this portion over here. And it doesn't have to break 31.54 to be profitable. Does that make sense? I haven't looked at anybody's comments until now, but does that make sense to anyone, or everyone rather? So when you're looking at price, okay, when you're looking at price, the reason why I try to draw your attention to these big runs in price is because it allows you to frame your trades. It gives you the context to say, okay, this is a bullish condition, but is that range offering me a number of pips in terms of where I can reasonably manage the risk and allow me a 3-to-1, 4-to-1, or 5-to-1 ratio? Okay, this is a good question, and this is the only question I'm going to take. Okay, so please don't be offended if because I want to make these short. If we look at where price is right here this morning, right there, that was the London buy right there. Okay, does everyone agree that why that's a buy? We had the down candle, which is a bullish order block. We have price run through, trades back down into it. Right there, that's the buy. Right there. Okay. If you look to the left, right there, where's the range? It's here. You see that? So when we're looking at voids, now this is really important, okay? Because you've heard me kind of like belittle supply and demand folks. When you're looking at voids, you do not cut through candles. Okay? Remember this. Write this down now. When you're looking to trade inside of the range, you do not cut through candles. You don't look through it. Okay? You just go immediately to the left. Now you see this is a void right here. Okay? Now, there are things that we talk about and we will talk about, which is recapitalization of old order blocks, which is over here. But when we're trading inside the range, and this is why I said you're going to have a lot of opportunities to pick and choose using my tools and these concepts to be able to frame what type of trader you want to be. Okay, so if you're looking to trade inside the range, right now, looking at price as it is here, if it was in London, excuse me, right here, this is the only exposed portion of this big liquidity void from this price level here down to this high. See that? From this high up to that level here, that's the only exposed area of the liquidity void that has not been traded up into. Well, that's why I didn't want to take questions, because I'm getting a million questions now. Why? What do I mean by cutting through candles? Just looking to the left, just understand that this is the only range that you need to be concerned about with right now, because outside of this, what's over here? A big consolidation. So we're only worried about trading inside this range, this high down to this low. Right here, it's offering a opportunity to be a buyer, and if it's going to go up, we should be reasonably expecting it to go up to this level here, which closes in this void. And I know some of you are still sticking on what's a void and how do I find it and what do you do with it, and that's what's being taught to you. Okay, but I got to have several examples to be able to show it to you, because one just won't do it. But if you keep going looking over here to the left, you're not finding a range, you're just finding more price swings. And you don't need that. You only need to see what the most recent price range was. And price was delivered aggressively down here. And you only need to identify where that void closes, which is the up candles here, by identifying that 132.32 level. And price is down here. It's offering you a range of about 40 pips from where you would be buying up to this price point. Does everyone get that part? That's all I really want you to understand that right now. That's all you need to understand right now. Okay, as long as you can see that this void here I highlighted and the range up to that point here offers you 40 pips. If everyone understands that, then I was successful today, okay? Because we'll build on this. No, Tanner, and Tanner's the person that I'm actually framing today's teaching on. Your trade was significant and it was done properly. There was nothing wrong with your trade. It was executed very well. Don't take anything that I'm saying as a derogatory or criticism. I mean, I'm actually acknowledging what you did was right. So the idea is, if you're buying down here on this order block and you're offering 40 pips, or the market is offering 40 pips in terms of range, okay, so that's what you're determining. You're saying, okay, what's the amount of range I have for profit? So the market should reach up to 132.32 relative to the buy setup that was taken by Tanner and shared on Twitter. But in hindsight, I'm speaking specifically about the bullish order block. If you're being a buyer down here, okay, if you're buying that, your stop needs to be below this order block. It could be 10 pips below it, okay? And if that's the case, we'll just say 31.75. So it's a 15 pip stop. So if you have 15 pips stop and you're looking for 40 pips of range to get up in here to close this void, what type of gearing is that in terms of risk to reward? Oh, it's essentially 3-to-1. And now if you're looking for a movement to sweep in above this level, which will be a bearish order block running into that, you probably may, I'm not saying you have to force these types of things, but you could probably squeak out, 3-to-1. Maybe, who cares? But as a new trader, you're not going to be getting 5-to-1. You're not going to be getting 10-to-1. You're going to start with 1-to-1 setups and see how consistent you have to be profitable doing that. And then we're going to grow into 2-to-1 and 3-to-1, and we're going to graduate up. But you'll leave the mentorship with your only setups are going to be 5-to-1 payouts. And that's why I'm trying to tell you, just because I can see these things and I can talk about them, and you've seen examples of me calling specific moves, and other people taking trades as well, I like setups that give me 5 to 1. So I'm willing to wait around for those to form. And I need to trade in time frames that allow those setups to form more fluidly. But there's the response off that order block, and it rallies right up to the void. I mean, look at the response. Look how beautiful that is. I mean, seriously, it hits that level perfectly. Right in there, boom, hits the high at 132.32. That's the exact opening price as we define it in terms of closing the void. I mean, that's perfect. I mean, seriously, I mean, if you're not amazed by that, to me, I think it's so fascinating to see how consistently price is delivered like this. It's not random. It goes right to these levels for a specific reason. Then it retraces, it comes back down, and it runs one more time through the high. So here's your 3 to 1. 3 to 1 would have been offered right here. Now, we've obviously talked about this order block, why it wouldn't be a good one. We would expect the stops to be ran and reach down into the order block. And then look what it does. It hits that level again. One more time it hits that level. Now, my question to you is this. Does this look like a market that wants a top like that? We have about an hour left of the daily range. Does this look like a market that wants a top? At least in the price structure that's offering right now. And does this look like the way the dollar would be topping? Right. So I'm going to leave the rest of the day, and I'll come back to you by way of Twitter on charts around noon, and we'll recap through charts only, okay? And I'll have a daily recap video at 3 o'clock and posted by 3:30. Or it may be a recorded session. I may not be able to do it live today because my wife's my wife's giving me an agenda today I got to take care of. So I have to run some errands for her and help her with the kids stuff. So it may be a pre-recorded session. I'll have it done by 2 o'clock and online by 3, no later than 3:30. Okay. Yes, you're going to have London sessions, but they begin in New York. I'm sorry, in November. Okay. So that's it for today, guys. Hopefully you found this insightful. I will give you the recording when it's done, and I will get back to you later on as well around 3 o'clock. Take care. Good luck and good trading.